Good evening and welcome to our very last live event of the year. For those of you who don't know me, I'm Donald Leggett, Head of Investor Relations at London South East, and I'm your host for this evening. Now, what our growth companies have in common tonight is a low market cap relative to their net asset value potential. And most of our companies speaking are probably familiar to you. We have Atlantic Lithium, who were formerly Iron Ridge Resources. We have Longboat Energy. We have Cora Gold. And the one new to me is the biotech company, ValiRx. As usual, each CEO gets 30 minutes to make their investment case, with around 18 minutes spent talking to slides, and then we take questions from you. Our first company tonight was called Iron Ridge Resources 3 weeks ago. Since then, it has successfully demerged the gold assets into a separate unlisted business called Rica Resources, and it has changed names to Atlantic Lithium. This morning, Atlantic upgraded its scoping study for the Ewoyaa lithium project in Ghana, incorporating the increased JORC resource of 21.3 million tons, resulting in a significant improvement in project economics and life of mine. 3 weeks ago, the market cap was around 120 million. Now it is around 138 million pounds. So to that extent, it has been a success. And tonight, CEO Vincent Mascolo joins us live from Australia.
Good evening, London, and welcome to Atlantic Lithium, formerly called Iron Ridge. Atlantic Lithium now is a West African-focused lithium spodumene concentrate developer and explorer centered around Ghana and Cote d'Ivoire. And as Donald suggested, has stated, we today announced our scoping study upgrade, and we'll be talking a little bit about that later through the presentation. So welcome, everyone. Here's our standard disclaimer, and just in case you want to rush in and buy the stock tomorrow, read this carefully, it's riveting stuff. Look, as a corporate business overview, today we're going to touch upon a few key elements, and the overarching element is we are set to establish West Africa's first hard rock lithium mine. We have a high-grade lithium spodumene deposit in Ghana called the Cape Coast Lithium Portfolio, and more specifically the Ewoyaa project. And this Ewoyaa project in Ghana has significant exploration upside, strong ESG credentials, which we are rapidly advancing to development through the full funding investment package provided by Nasdaq-listed Piedmont Lithium. And we'll touch on all these elements through the presentation. But once again, the refreshed corporate snapshot. I guess the key takeaways here is our new ticker is ALL, ALL, listed on AIM. We have significant and like-minded shareholders in Asor Limited, DGR Global, Sumitomo Corporation, and recently to the register on the back of their investment is Piedmont Lithium. We have a very healthy treasury of around 20 million US today. We're fully funded and we have no debt. So just a touch on our joint venture partner that's funding this project, providing Atlantic Lithium in shareholders and investors with a 50% free carry and 50% life of mine product. Piedmont are a Nasdaq-listed entity establishing themselves to become America's #1 lithium hydroxide producer. We also share their vision and believe in their capabilities. Piedmont already have established relationships with Tesla and many other US-based automakers, which gives us a leg in without much work. Piedmont also, as you can see from Keith Phillips' quote there, also sharing the belief that our Ewoyaa project is an industry standout and leveraging off world-class infrastructure. The Piedmont investment is a 3-stage investment. Stage 1 is completed with 16 million US into the Atlantic Treasury. Stage 2 is well underway, where Piedmont Lithium have to spend in aggregate 17 million US dollars in two segments or 2 areas. One is regional exploration to expand the resource even further beyond today, and then to take the project to DFS studies so we can fast track the development to sales. And then stage 3 is obviously once they've completed stage 2, naturally they progress to stage 3, and they will fully fund the Ewoyaa lithium project to development. It's a pure joint venture. It's a 50-50 joint venture. We will now share any savings and share any pain in cost overruns. But I guess the key takeaway for Atlantic Lithium shareholders and new investors is that we are getting a 50% free carry. We no longer have to spend any money, and we still retain 50% of the product rights. And we have given away no rights, preemptive or otherwise, in respect of the life of mine product, our 50%. Atlantic Lithium also retains its Côte d'Ivoire projects 100%. Look, the benefits to Atlantic shareholders and new investors is very simple and numerous. Firstly, the project endorsement and instant access to the rapidly growing US-based EV markets. Atlantic is fully funded, and we have no debt, and and we have a healthy treasury in the order of around US $20 million. And once again, look, I'm going to harp on this through most of the night or day, or evening, I should say, is that we retain 50% of the product, 50% of the project, without having to spend any further capital expenditure into the opportunity. This is a great de-risking investment opportunity for new existing shareholders and new investors looking to come into the lithium space. As most of you have probably seen today, we made another landmark announcement with our scoping study upgrade on the back of last week's mineral resource estimate of 21.3 million tonnes of 1.31% lithium oxide. The scoping study once again has delivered very impressive numbers. And just to touch on a few of those numbers, we now have gone from an 8-year mine life to 11.4-year mine life. We're now looking for a potential of greater than 15 years. The NPV post-tax is just shy of 800 million. Life of mine revenues now in the order of $3 billion, in excess of $3 billion, all on the back of a very conservative $900 US per tonne spodumene concentrate price over a long term. We are set to become one of the world's lowest lithium spodumene cost producers, with an OPEX all-in cost of around $249 US per tonne after byproduct credits. All this can be done within a payback period of less than 1 year. A phenomenal return on investment of around 194%. This is unheard of, and there's a number of reasons for this, and we'll talk about those later on, with the number of reasons why we have delivered such robust and commercially viable numbers. So look, we're in pole position to service the US markets. Most people already know this by virtue of the deal we've done with Piedmont. We also believe that we will be able to capture some of the European markets, and through the new company namesake, Atlantic, and through the Atlantic Ocean. So look, our robust economics have been derived very simply from exceptional geology, metallurgy and mineralogy, and obviously our proximity to world-class logistics. We're 1 kilometre from this road, we're 110 kilometres from this port, and we have multiple green energy, high voltage power lines running adjacent our site. We also only have we have a very simple processing flow sheet. It's DMS only, which saves us a lot of money in CapEx and OpEx, because we don't need flotation. It's quite a rather unique situation that we're in. And we've also pilot tested in laboratories our products through to carbonate and hydroxide with successful results. Look, the Cape Coast and Côte d'Ivoire lithium portfolio, just tonight I'm just going to focus on Ghana. We've drilled in excess of 84,000 lineal metres of RC and diamond drilling completed, and it's ongoing today. But look, I guess the key takeaway here for this slide is you can see the deep sea port of Takoradi, which is down here. It's 110 kilometres from the project site, and we're effectively halfway between the capital city of Accra and the deep sea port, ideally located in the townships. And what this means is that basically most of our people that work on the site go home for dinner at night, be with their families. As you can see, here's a picture of our spodumene in the ground and in core. And as you can see, the coarse nature from the image. And what this implies is we have a very simple processing flow sheet. It's DMS only, and we keep emphasising that because that is one of the key rationales and reasonings for us having such a competitive CapEx and OpEx by peer comparison. As we announced last week, our updated mineral resource estimate has grown from 14,500 million tonnes at 1.31% lithium to 21.3 million tonnes at 1.31 million at 1.31% lithium oxide, with optionality to expand that mine life even further. To date, included in this resource is only just over 56,000 linear metres of drilling. We still have 28,000 metres of infill and extensional drilling with results pending, and this will certainly add to the resource twofold. And where we'll see the benefits of these additional results will be increased confidence in the resource status, and we believe additional tonnes in quick step. Look, one of the key elements, and we keep talking about DMS only, and it's a rather unique situation we find ourselves with our Ewoyaa project, is a pure lithium spodumene mineralisation. It's coarse grained, and what we are repeatedly seeing, and as you can see from the variability line here, that we're consistently achieving results greater than 6% concentrate. And that bodes well for a very simple processing flow sheet, and that's why we have a very low capital intensity by peer comparison, and all our costs are within the first cost quartile. Look, folks, this is really the money shot and what makes our project absolute standout in the marketplace. We are 1 kilometre from this national. We are 1 kilometre from this national highway. We are 110 kilometres from this deep sea port of Takoradi, and we have multiple high voltage power lines being fed by this hydro dam in southern Ghana. It's these exceptional logistics that fundamentally also drive the opportunity and low costs associated with the company. Look, the fundamentals support a robust scoping study. I won't run through these numbers in great detail, but what you can see is our main Ewoyaa deposit here, all these little highlighted pink bits showing, that's the main deposit area, and all these other satellite deposits. Now, the beauty of all these satellite deposits is that they are all outcropping. So we have a relatively low stripping ratio also, once again, by peer comparison in the marketplace. And to have all these fundamental numbers come in a payback period of less than 1 year is rather phenomenal. So we have very strong ESG initiatives in Ghana. We are very well advanced in our environmental and social baseline studies. In fact, we're nearly 2 years, we're nearly through 2 cycles of wet, dry and social and community liaisons. We have a strong national team. Just over 98% of our team in Ghana are nationals. And as I said previously, the beauty of the location of our project is that 70% of our employees in Ghana live within the Mankasim Cape Coast district, and they all go home for dinner at night. So that's a huge positive for Ghana and a huge positive for the project. In respect of low carbon footprint, it stands to reason when you have operational logistics so close to your project, it always implies that you're going to have a very low carbon footprint, which we can enhance further with the hydropower supply running adjacent our site and other initiatives which we are currently looking at. As part of any developing project, it's always good to have significant exploration upside. In Ghana alone, we've only drilled 13 square kilometres, about 560 square kilometre tenure package, and it's all been centred around the Ewoyaa Mankasim district. We recently had the Cape Coast significant tenure package granted to us. So we're looking forward to sinking our teeth into that early in the new year. And look, with such a vast tenure package, largely underexplored, we have a significant line of sight to multiples to the current resource status. So, two key elements there: significant project, fast tracking to development, and significant exploration upside. I guess to conclude, and thanks for listening, you can see here on the screen, this is our team in Ghana. And we would encourage everyone and anyone to follow us on our social channels and platforms. Thank you very much, and I look forward to your questions.
How excited are you by this project, Vincent?
Very excited. We just need to get investors more excited.
Yes, that's quite an amazing thing you found there, Vincent.
Look, it is, and doff my hat to Len Koff, our Chief Geologist and Chief Operating Officer. This was very much a first principles discovery from literature review. We flew into London, went to the universities, collated the literature, and then flew into Ghana and secured the tenure package we have today. So this is a discovery from Greenfield's first principles.
Now, you say you've actually only drilled a certain amount of your tenure. How confident are you that the next drilling will just produce the same high quality spodumene?
Look, we're very confident because what we're seeing, we actually are able to visualize now or to visualize into numbers what we're seeing in the ground without having the assays, having received the assays. So we're very, very confident that the results pending, the 28,000 metres of drilling results that are still pending, are going to deliver increased confidence in the current resource and add quick tonnes. And then, beyond that, it's how long is a piece of string? I mean, 560 square kilometres, only 13 square kilometres drilled. The upside is very significant, and we are very confident of further discoveries.
Okay, J. Deacon asks, just to clarify, he says, I believe we have 100% free carry in return for 50% of the project. So 100% free carry in return for 50% of the project. I do believe you said 50%. Yeah,
Piedmont Lithium have to spend 100% of the money to take the project to development, or the 70 million on a CapEx spend, and we retain 50% of the project and 50% of the product.
Very good. Well done. Let me ask you, you may think this is a slightly cheeky question, but are you already talking with larger miners, or are larger miners, more correctly, probably coming to you and starting to talk to you? I mean, that scoping study, the updated scoping study today, means you're going to get people knocking on your door, aren't you?
Look, they're already knocking on the door, chasing down our remaining 50% of product. It's a little overwhelming and complimenting, to be honest. Everyone sees our project as a great startup. It's a very doable project. So look, I guess in short answer to your question, Donald, the answer is yes, we are talking to a lot of people every week.
What might an exit actually look like, Vincent? I mean, would you be tempted?
Tempted for what?
Well, you tell me. That's your part of it. Do you want to see this to production, or would you think this is phenomenal? Someone comes in and gives me a large chunk of money, I will sell this.
Look, I think we take there are multiple exit strategies that could be adopted. But look, our view is that anyone that wants our project, they want it because they want to take it to development. So our strategy is we just keep moving forward to development, production, and sales. And what usually happens is someone throws a really nice number at you that makes you stand to attention and have to think twice. I think the key element there is that even at these languishing share prices, anyone that any potential bidders for the company would need to be done by a scheme of arrangement, because we have so many shareholders on the register that are like-minded and genuinely and sincerely believe that we are hugely undervalued at these prices.
Okay, Russell Palumbo asks, the obvious next question, which is Piedmont Lithium. Might they be interested in taking the further 50%, or even a chunk of that 50%? You're on the inside. What's your thoughts on that?
Yeah, that's a very good question. I ask that question myself almost every night. I think the logic, and I don't have an answer. I think any potential suitors are always going to keep those cards close to their chest. But look, I think it would make logical sense. But we are the key to our success here, and for existing shareholders and new investors, is everyone's interest in our project is to retain the product. And that's why we never gave away any rights in respect of our 50% of product. And that's what people are that's why there are so many suitors circling, and it's for that remaining 50% of product. So we're going to hold on to that tightly and dearly until we can actually either achieve the right result, or we're just moving to production. And as you can see from the numbers, some very impressive cash flow numbers and revenues streams to come in short time.
When might first production be then, Vincent? That's the next obvious question.
Yeah, that's going to be your next difficult question.
All my questions are difficult questions.
Yeah. Look, from our perspective, we're targeting by the end of 2023. That's what the legislation will allow, and the rules in Ghana will allow us to achieve. Now, that assumes everything goes to plan. And look, with a supportive government and strong ESG credentials in country, with over 98% employment of Ghanaian nationals, we have the full support of the governments from the highest level all the way to the presidency down to the local communities. So I've lost, what was your question again?
When might first production be?
2023 is our target for first production.
Is it a challenging target, or is that easily achievable?
Look, if everything goes to plan with a supportive government, we think it's very achievable.
Okay, that's a great answer. Well done. What's coming up in the next weeks and months in terms of news flow, which might be a catalyst for the share price? Well,
we're thinking about a novel idea of just putting no news flow out, Donald. We might get a better result.
You've had a lot of positive news flow lately. It's true.
Yeah, it's not reflecting yet, but hopefully we'll get there. Look, I think the mineral resource estimate upgrade we provided last week, and the scoping study upgrade we provided today, your day, suggests there's a lot of news flow to come. We've got 28,000 metres of drilling results pending, and we're advancing the other exploration assets within the Cape Coast portfolio. So, look, news flow is going to be continuous all the way through to next year. And I think it'll start with additional high-grade drilling results, enhancing the status of the current resource and expanding and providing comfort to investors and shareholders that the resource is going to expand as expected to a minimum mine life of greater than 15 years.
Okay, you're not going to love me because I've been keeping the tricky one to the last. Carl Denver asks, what can we do with the Rica certificates? Apparently we can't trade them. Halifax, my broker, says they haven't received them yet, and we can't take part in the 10% offer. I've got a couple of people, Josh Cole is also asking a similar style of question. What to do with Rica?
Okay, yeah, look, this has been a bit of a challenging one for us. We've been working around the clock trying to liaise with brokers and nominees and custodians. But look, I have to remind, and I'm in the same boat, I'm having a similar issue to take up my entitlement. But look, what I have to remind people is that it's their broker, it's their custodian. The custodians and their brokers have no obligation to be listening to us. But look, I believe what we've been doing and pushing behind in the background has yielded some success. and it's unfortunate that some may miss out, but we're looking at other ways to try and circumvent that. But look, once again, you need to push your broker and you need to push your nominees.
Yes, Hargreaves Lansdowne. 3 weeks ago, the problems were with Hargreaves Lansdowne. 3 weeks later, they're still with Hargreaves Lansdowne. A lot of people in the Telegram groups are reporting back from UK brokers that they claim all, as in you guys, has not sent the required documentation to carry this out. Have you sent the required documentation?
The documentation has been out for weeks, Donald. It's also on our website. And we've repeatedly told from the onset when we put this, when we gave a timetable update, we put out frequently answered questions in that RNS, and we told people exactly what they need to do. Look, I believe people have been pushing, but there's just been some sort of resistance. And look, we're also overnight, we've been speaking to Hargreaves to try and get them to play the game. So look, all I can suggest is you just keep pushing.
Yeah, that's very good, very good. Okay, final question. Russell Palumbo, what do you believe to be a fair market cap at the moment as opposed to the current 138? Many multiples of where we are. I mean, if we were to do a peer comparison, our nearest peer comparison would be on the ASX, would be Cora Lithium. We have a significantly greater resource than them now. They're probably about 12 months more advanced to develop than us. So if you want to use that as a peer, you can make your own judgment, but it would be definitely many multiples of where we are today. Even
that should really be true
even
value.
Very roughly, what is Cora Lithium? Where are they at the moment?
I think they're around 800-900 million market cap.
That would do very nicely, Vincent.
Very much so, and I think our investors and shareholders would be very pleased with that result.
Thank you. You're a star. Well done. Thank you, Vincent. Okay, our second company this evening is AIM-listed ValiRx, who are looking to become a contract research organization or a CRO specializing in cancer and women's health drugs. What's interesting about them is their letter of intent to license Val 201 was signed in early November with TheoremRx, and Val 201, for those who don't know, is a short peptide being studied as a potential treatment for prostate cancer. The potential value of the deal would be in excess of $61 million US, plus royalties for the first cancer indication, with a further $37.5 million for each later indication. And I've done the reading, and that's not out of the realms of possibility. Suzanne Dilley is CEO at ValiRx, and she's with us tonight. And welcome, Susie.
Thank you, Donald. Good evening. Good evening to the audience as well. First of all, I'm sure everybody presenting here tonight will present something very similar as the first slide, but this is just the disclaimer to say that clearly we believe that what we have in ValiRx is very valuable, and we would love to have more of the audience as shareholders, if you're not all already anyway, which of course I hope you are. But this is just a reminder that please do your own research. Don't rely solely on the contents of this presentation in order to make a decision about whether to invest in ValiRx. So with those pleasantries aside, I'd like to introduce you to the overall strategy of the company. So I'm very appreciative of Donald for that introduction and introducing us as a new strategy of wanting to be a service providing company, a CRO, as he defined. And we'd like to take a step back to have a broader overview of the company strategy to start off with. So what we do in ValiRx is we identify programs at a very early stage of the drug development pathway. And we take these typically from universities, but they can also be from charity funded research or from other biotech companies. And we take these programs, these are therapeutic development programs, usually small molecules or synthetic peptides in the areas of oncology or women's health. And we take these programs from the stage of lead optimization, where a drug candidate has just been proposed and is looking promising for development towards clinical trials. And we carry out the preclinical development stage of work. So this is all the regulatory required studies that prove the safety of the drug and provide confidence before the drug candidate enters clinical trials that it has a good risk-benefit profile before it enters the first human testing. So this stage of preclinical testing is quite challenging for those entities such as universities who carry out the early discovery to do, because it's usually that stage where it's a little bit more expensive. The labs have to be run to a particular standard, and perhaps those experiments aren't quite as interesting as the experiments that the academics would like to run, which are typically really quite imaginative experiments with all the bells and whistles and absolutely the top newest innovative technologies that they're developing in the university. So we'd like to take the program at that stage and really build a corporate framework around the program so that we take it through to the stage where it's clinic ready, that is ready to enter clinical trials, but also partnership ready. So by encouraging the academic innovators to develop alongside the project, we can have a strong team, but also a strong corporate framework by ValiRx providing that experience of setting up companies and of building everything that a company needs behind it before it enters clinical trials. At that stage, we then look for third-party funding or for a third-party partner, perhaps a larger pharma partner or a larger biotech partner, in order to fund the clinical development. Now, this is a bit of a deviation to our strategy from a few years ago. So ValiRx, a few years ago, used to take programs through to the end of phase 2 clinical trials in order to hit that value inflection point where you have the clinical proof of concept and real confidence that the product's going to work before looking to pass on to a larger pharma partner or another biotech partner. Well, we've decided it's more important to focus on the preclinical section of work so that we can de-risk the programs, we can carry out all of that science that's needed to make those programs clinic ready, but without having the larger expenditure of the clinical trials. So we believe that this creates for our investors a pipeline of programs that will be faster moving, will be less expensive to run, and will provide news flow on a more regular basis when we've got it up and running. So when we consider this strategy, clearly we're not the only people who are identifying good science in universities. So what really makes ValiRx unique? And we believe that the really unique point of ValiRx is our ability to draw 3 separate strands together and to integrate that in a way that makes our translation service, if we call it that, really a unique prospect. We have the science expertise in the company because we have taken programs through clinical trials in the past. We have that experience to develop preclinical programs with the end point in mind. So we have that edge over people who are just specializing in preclinical, as they have done all the time. But as an AIM-listed company, we also have a fairly unique blend of commercial and financial expertise so that we can introduce those programs while we're building that corporate framework around the program. We'll be placing them into special purpose vehicles, subsidiaries of ValiRx, which will be able to go out and talk to third-party financiers, whether that's venture capital or whether that's the larger pharma partners to look for partnership arrangements for funding clinical trials. We can support that because we know what those larger partners need and what they want to see in a product. And we also have that commercial experience of negotiating deals. And I think that that's exactly what we've demonstrated recently with our Voucher 1 program. But I'll come on to that in a little bit more detail in a minute. So looking a little bit more about the drug development pathway and why it's so important to have specialists in each stage of that process. So what we've displayed here on this slide is we have the 1 to 20 representing the 20 years that a patent is in force for after application. So as soon as you file a patent, whether or not it's going to be granted or not, the 20-year clock starts. And at the end of 20 years, the patent is no longer in force, which means that all of the information that you've published and all of the information that has to be placed into the patent is available to the wider world to use, to copy, and to produce competing products for. So you really have quite a strict 20-year timeline on this to develop the drugs and to sell them in order to make that profit at the end of the process. And you can see here that even when you're looking at really quite an efficient timescale, and these are timescales for preclinical phase 1, 2, 3 and market authorization, it's taken directly off the FDA website for their guidelines of how long it should take. But even using these really quite optimistic timelines, you still only have 7 years at the end of the patent life in order to make sales and to make that commercial return on the product. So it's really important to make sure that each player in this pathway does what they do in the most efficient way possible. And we believe that the best way to do that is to be highly specialized. So you can see here that ValiRx is specializing in the preclinical arena, as I described earlier, and that we have these overlaps with the other parties who are taking part here. So we have the universities here carrying out the early discovery and hopefully being able to pass on their good programs to ValiRx, where we can develop them through the preclinical pathway to make them appropriate for adoption into either larger biotechs or to big pharma. Now we note here we've made a fairly tentative link to big pharma here. Typically the larger pharmaceutical companies will take programs from phase 2 or later when you've got that first proof of concept in clinical testing. However, in some areas, and particularly in areas such as women's health, where there's really quite a scarcity of programs around the preclinical arena at the moment, big pharma are starting to stretch back earlier, and they're certainly talking about taking programs a lot earlier than they have done in the past. But we also detail the other players here that also operate in this space. So the mid-sized biotech and SPVs that we put here, this is to detail the mid-sized biotechs, typically are family office run biotechs. There's quite a few around Europe that aren't household names, but really are quite significant companies that take programs from late preclinical. And although we've highlighted here that they quite often take them to phase 2, sometimes they actually take them a lot further than that as well. But the SPVs that we've highlighted in this box, we've particularly stressed here because this is the type of company that we've licensed or that we've signed the letter of intent to sublicense VAL201 to. So this is a special purpose vehicle that's been set up. In our case, TheoremRx is being set up by a group of industry experts in order to take a small pipeline of programs, of which we believe VAL201 will be really the centerpiece of their work, and to take those through into some important stages of clinical development to, in the case of VAL201, to enhance the clinical data that we've already developed and in order to move it forwards. So this is becoming more common. The group of industry experts, particularly in the US, get together, and these may be ex-pharma people. They may be, in our case, we named Ken Sorensen on our RNS release about TheoremRx. He's a patent agent, or used to work in the USPTO. And it's people like that who have the expertise to take programs forwards, who can get together and raise money around a particular product or particular group of products that they believe will sit well together and will make them attractive and make the products attractive to larger pharma companies a few years down the line. The other type of entity we've highlighted here is Biotech Platforms. So this is to highlight the fact that there are some companies who have interesting platform technologies, who sometimes offer these platforms to the wider industry as services, while also developing their own in-house pipeline. Now, this will be an in-house pipeline that uses their platform technology and will quite often generate quite a few hits. From that, there's those drug candidates that fall into our sphere of interest. And that's another source of programs for us, that we can potentially take programs where they've been generated by a platform and perhaps that biotech doesn't have the resources to take forwards everything that they generate. But as you can see on the biotech platform box, that actually overhangs in both directions to our area of expertise. So in some cases, we might actually be passing programs on to them as well as taking them off. So I hope that this diagram really gives an overview of exactly where we sit, how we sit amongst the other types of companies, and why we think it's really important to specialize in this area. Now, while we're looking at this, we want to also consider how we can better enhance our expertise in this very specific area of preclinical development. And we think that the next stage for ValiRx is to look at expanding our capability by actually looking for platform technologies or facilities or capabilities that would enhance our our ability to carry out those preclinical tasks, but actually to carry it out in-house and not necessarily to outsource everything as we do at the moment. So although it's very typical for a biotech such as ValiRx to be virtual, to not necessarily have our own labs that do everything, but to send a lot of work out to third-party labs, because this avoids us needing to finance all of the equipment we need, actually having a basic capability that will allow us to do some of the work in-house could actually create some rather interesting opportunities for us. So that's what we're looking into doing now. We're looking at where we can expand our capability and expand our ability to carry out that preclinical research by bringing in-house some interesting facilities or technologies that would enable us to do that. And again, just as before, where I asked what makes ValiRx unique, we have to ask why now? Why do we believe that now is the time to start bringing this together? And we believe that the answer to that is data. So there's a lot of new platform technologies out there at the moment that are generating a lot of data. You only have to look at the frequency and the ease of genomic sequencing, for example, over the last few years to know that the amount of data that's generated now at affordable prices is huge compared to where it was 20 years ago. But that comes with its own problems as well as its being a solution of its own, because we can generate a lot of data, but what do we do with the data when it's generated? And this is where I'm probably going to get slapped over the wrist here by our chairman, Kevin Cox, for using the word AI, but it's the word that I always end up using when I'm considering this. But the use of AI, the use of algorithms, the use of better technologies to handle that data, to process that data so that it becomes a lot easier now to handle huge data sets and to extract interesting things out of that data set. But actually there's a third step to this as well, and that's the data application picture on this slide, that it's all very well generating data and understanding what that means, but you have to be able to implement it as well. Otherwise you're just generating data for data's sake, which is great for academic publications, but less useful if you don't actually apply what you've learned to planning your clinical trial better, or perhaps de-risking that drug pipeline. And what we want to be able to do is we want to identify lab capabilities that will enable us to generate data, analyze that data, and then understand how that data can better consider the drug candidates in our pipeline to make sure that we understand the biology to the best extent that we can, and that will enable us to move those drug candidates into the right diseases. So, for example, I've spoken about women's health conditions a lot in the past, and we believe that there's a lot of drug candidates in development already for other diseases that could very easily be directed towards diseases of women's health. But actually, early stage drug development workers quite often don't push it in that direction because the extra toxicology studies that you have to do before you can enter clinical trials in women, particularly of women of childbearing potential, so women anywhere between 20 and 50, is really difficult to get those women into early stage clinical trials unless you have a more robust preclinical data package. And knowing that you have the confidence to spend that extra resource in developing that package is something that we believe we can support by better data generation, better data understanding, and making sure that translates into thorough biological understanding of all of our programs. So that's where we want to be. That's what we believe we can create. And I think I've probably already covered most of our strategic ambition in those past couple of slides, but we want to aim everything that we're doing and everything that I've talked about, how we're going to do towards making good drug candidates in women's health and oncology. Now, because we have a lot of oncology experience and some women's health experience, at the moment, we anticipate that a lot of the women's health work is going to be women's health oncology and the gynecological cancers in particular, but also we've recently taken in a program under evaluation in triple-negative breast cancer. So we're looking to develop programs in that area. And we believe that by building our capabilities to generate that data and understand the biology better, that we can do that. And when we're talking about women's health, we're not just talking about those diseases that are traditionally associated with women's health. Of course, our endometriosis program is absolutely central to our work and is an important part of our pipeline. But also diseases such as lupus, which is predominantly affecting women, but other diseases as well that are just less well served for women. So diseases where the treatments are available for everyone, but actually work better in men, or perhaps the doses need changing for women, and that there just needs to be more considerable thought into making sure that the data understands that both women and men need drugs developing for them. So very briefly, because I appreciate I'm running out of time here, looking at the pipeline as it stands at the moment, I think for the next time we do a presentation, I'm actually going to flip this slide round, because the most important part of our pipeline as it stands here, or one of the most important parts, is the triple-negative breast cancer program under evaluation. So we announced this a month or so ago, that we've taken this program under an evaluation agreement from a London university. Unfortunately, we can't say much more about it at the moment, but that's currently undergoing some preclinical assays, as it will for the next around 9 months, probably, while we assess whether it's scientifically and commercially relevant to take into a full licensing agreement for us, so that we can run it properly through all of the preclinical development stages that are needed to make it clinic ready and partnership ready. And this is where the future lies in this pipeline. It's those programs that we're bringing in new, initially under evaluation agreement, and we hope there'll be a few more of those in the coming months as we continue to talk to universities and to continue to negotiate these agreements with them. But then also, importantly, on this pipeline agreement, you have VAL301, our program for endometriosis, which is our flagship women's health program. Now, this is still in preclinical development, and it is under evaluation by Japanese pharma, who are carrying out their own preclinical work as well, in order to consider whether or not they would like to further develop it with us. But even while that's ongoing, we're also carrying out our own work on this program to ensure that it can now move forwards at an efficient rate to make this clinic ready, so that it can look for a partner to take it forwards into clinical trials. And then finally, also on this, we have VAL201 and VAL401, which are the programs which we define as our legacy assets. So these are programs that have been in clinical trials and that we are actively looking to out-license. So VAL201, clearly we can't be too active at the moment, because that is now under an exclusivity agreement with TheoremRx under the letter of intent that was signed last month. And we're, as we announced in that announcement about the letter of intent, we're hoping that the first payments from TheoremRx will arrive before the end of the year. As far as we're aware, that's still all on track and ongoing. But as we announced that timeline in the RNS, clearly we will have to update all of our investors if that changes. Clearly, we're not expecting that to change, but if it does, we will let you know and let you know what the new timelines are. If it is extended, we wouldn't expect it to be extended by very much. So I think that gives you a very brief overview of ValiRx, and I'll leave you here with the contact slide. Obviously, we have an opportunity for questions and answers now, although perhaps a little shorter than Donald intended, because I've spoken a bit too much there. But please feel free to email any of us if you have any questions that aren't answered today. Thank you.
Okay, Susie, thank you. That was absolutely fascinating. Well done. Let's do TheoremRx again, because it is very, very important to you guys. I presume in the history of ValiRx, you haven't ever got anything to such a large amount of money stage.
Well, it's absolutely crucial for us. And I haven't been I've been on the board of ValiRx for nearly 18 months now, but clearly I was involved in ValiRx before that as part of the ValiSeek subsidiary. So to the best of my knowledge, this is the biggest thing that's ever happened to ValiRx. VAL201 is the flagship program for a very long time. The majority of resources over the last 10 years at ValiRx have been directed towards VAL201. So to now be able to be in a position where we can monetize that, we can bring cash back into the company in order to spend on our new programs and to really start turning that over. It's fantastic. But best of all, it shows a validation of our strategy, that we can develop projects to a point where they are of interest to people that we can make those negotiations, we can make those commercial agreements. And with a group such as TheoremRx, which are one of these, as I spoke about earlier, one of these special purpose vehicles that's been set up specifically to run Biotech in a small pipeline of programs, it's really exciting. And I'm really looking forward to seeing what they do with it over the next few years.
So you have a lot of faith in TheoremRx?
Absolutely. We've been working really closely with them for most of this year. And certainly that's intensified even more over the last few weeks, as we've really got to grips with exactly what they need on science and exactly what they're going to do next. So we've been starting to line things up for them and helping them with looking at exactly how it's going to work when they start their clinical trials.
Now, Mike, could we go back to slide number 8, please? Oh, you're a star. Thank you, Mike. When you get that money in from TheoremRx, let's be positive and say it's going to happen at some point. Where will that money get spent? And how much money do you get initially? And where will it be spent? And it will be spent on any of these programs? Will it help advance any of those programs? Tell us more.
So the program that's coming in for Biotech, I think we highlighted in our RNS over the first couple of years. There's a number of near-term milestones in addition to the upfront payments that we're expecting, and ongoing service consultancy agreements so that we start getting a regular income from this. And this is really intended to cover working capital. And when I'm talking about working capital, it's not just the administrative costs, but working capital to include our budgeted evaluation agreements and taking those programs that succeed in their evaluation agreements through that preclinical development section. Now, clearly, that's quite a significant section of working capital when I start including quite a bit of R&D in it. And that is really the core of our business, is developing this in-house side. But because we're looking at expanding our capabilities by bringing in new technology platforms, we'll be able to actually bring in revenues from that side as well. So because if we can bring in a few of these technology platforms, particularly where we can bring in platforms that are already offering a service to the wider industry, they can be generating revenues, they can become integrated if we have more than one platform, which is the intention, that they can work together and to the wider industry, as well as us being able to use their technologies for an in-house pipeline.
So the TheoremRx money, it goes to underpin the new strategy, effectively.
Absolutely. So I've drifted off the original question there, haven't I? So the money coming in from Theorem will be used for working capital and those evaluation agreements, but that money will also be bolstered by money that's going to be coming in from the services that we're going to be offering from the platforms that we're hoping to identify. So
I've had a question, which is, it sounds like quite a tough question, and I suppose it's a sad one, really. Richard White has been a shareholder for a number of years. He's heard previous presentations with similar content. He's invested thousands in ValiRx in the past few years, hoping to support your kind of research, which, to be honest, does sound fantastic. But as he says, to my substantial cost. Why should I believe that this time around it'll be any better now? Richard White.
Well, I think I have to say that I've been on the board of ValiRx for approximately 18 months. Shortly before the time that I took over, the market cap of ValiRx was less than $500,000. It now stands at around 20 million, 20 to 25 million. And when you do the peer group comparison, clearly we believe that we have potential for the market cap to be significantly higher, even before any further developments or further development of the capability can be carried out. So in the time that I've been on the board, I believe I've generated significant value for shareholders. Now, clearly we do sympathise with those shareholders who have held for longer and have not seen that value reflected in the share price with respect to the share price that they originally bought at. Clearly we can't change the past. And I have to emphasise that although I was CEO of the ValiSeek subsidiary, I did not have significant sway on the board of ValiRx prior to my appointment to the board 18 months ago. So
why not, Susie? You have significant sway now. So.
I would like to make sure that the board hear you say that. And but I do stress that it is not a dictatorship in ValiRx. we have a board, we have scientific advisors, we have commercial advisors, and we make sure that everything we do is well considered. We make sure everything is budgeted. We keep costs under control.
Let me just quickly ask you one last question. I do apologise. How do you see the preclinical pipeline developing over the next 12 months? And with the new funding coming through, are there any opportunities for early cash generation?
The opportunities for early cash generation are really around the technology platforms and the revenues that we can bring in from that.
Not about speeding up Japanese pharma company who've been 18 months and not done very much with the data studies.
I think that I'd be very surprised if any shareholders know exactly what the Japanese pharma company's done or not done, because I think
they don't know who they are, for one.
Well, that's very much their choice. And likewise with the London University that doesn't want to be named, we have to respect our partners' right to confidentiality when they want it. But of course, anyone who's going to be helping us develop our programs, we are always going to respect their wishes when it comes to that. But I always stress that we are developing BAL301 and endometriosis ourselves in conjunction with looking at the data that's being generated by the Japanese pharma company.
Sadly, Susie, we are out of time there. But Mike Scott asks, I must have intuitively been asking his question for him, because he's asked that very thing. But we're out of time. You're a complete star, Susie.
Fantastic. Thank you very much for the invitation. And I hope
it's been a real pleasure. I hope you enjoyed it. Now to Cora Gold. Cora Gold have been exploring and developing the Sanan Cora Gold project in southern Mali for some years now, and have been hitting their milestones with increasing regularity. Well done, Bert. Cora published a very positive MRE, or mineral resource estimate, in November. This added 200% to the resource, with 809,000 ounces, both indicated and inferred, at 1.15 grams per ton. If you're not into mining, 1.15 grams per ton of gold is very good. A definitive feasibility study comes in the first half of next year, and the open pit mine project has been underpinned by a $25 million term sheet from Lionhead Capital. Bert Monroe, CEO at Cora, joins us now. Over to you, Bert.
Brilliant. Hi, everyone. I'm Bert. As Donald said, I'm the CEO of Cora Gold. I've been CEO since January of last year. Cora at the moment is on a really exciting journey. We delivered a scoping study on the project in Mali at the start of last year, and are obviously rapidly moving towards completing a feasibility study by the middle of next year. Just to step back a second and just to overview Cora, we're AIM listed back in 2017. Our focus really is in West Africa. It's a massive gold region globally. We've got a number of permits for exploring for gold in southern Mali predominantly, but also in West Mali and also in Senegal. Our main project is called Sanan Coro. It's got a scoping study completed on it, which showed some very high IRRs. Importantly, we wanted to really grow out the resource further before we moved into completing a feasibility study, and we delivered a 200% increase in resources last month, which was really exciting and really pleasing to see. We're supported by some great shareholders. Hopefully some of you are here and listening today, but we're very pleased to have a number of very large shareholders who have also been very supportive of the business. And importantly, we've got, and fairly uniquely for a company of our stage in the life cycle in the sector, have got a very significant term sheet signed with Lionhead Capital, which should support the development of Sanan Coro post our feasibility study in the middle of next year. Just to go into these project portfolios, I won't dwell on it. And just to say also, if anyone wants to get more details that you don't hear today, you can always drop an email to Cora, and I'm happy to get back to anyone if I don't cover anything off or you're not able to get your question asked. So feel free to get in touch at any time. On the left-hand side of your screen, you can see that the Kenieba window, which has been arguably the most prolific gold belt in Africa over the last 20 or 30 years, a number of very significant gold mines, which are world-renowned, including Sadiola, Fekola, and others. So we've got a nice package of ground there. It's a reasonably early stage, but it's right in the right postcode, which is nice to have. Our main focus is on what's called the Yanfolila belt, which is in southern Mali on the border with Guinea. Our main project is called Sanan Coro. It's a block of 5 permits, which are all contiguous, which you can see hopefully just to the east of the Kabada project. We've also got some permits I'll talk about later, which kind of donut around the Yanfolila gold mine, which offers some secondary optionality as well, which is of interest, but I'll talk a little bit later about that in the presentation. Other than myself, I think it's been really pleasing to see the development of the team over the last 18 months. I think we made some important hires. Norm Bailey joined us from Centamin. He had previously been involved in over 30 million ounces of discovery, all in West Africa, really. He was with the Redback team, which drilled out and discovered Chirano, which was over 6 million ounces of gold, and also Tazias, which I think went to over 20 million ounces of gold, and he was their exploration manager, head of exploration there. So he's got a great track record of discovering ounces in West Africa, and more recently brought in Russell Bradford as our project manager to oversee the DFS. Russell's got a great track record as well. He most recently built a mine called Asanko in Ghana, so he's got direct experience of building gold mines in West Africa. So a great guy to have on the team. Also, just added Pete as well, Pete Whitbread-Abruta, as an ESG advisor. And we've actually just hired an ESG manager full-time in country as well to help oversee and improve our ESG engagement in Mali as well. Dipping into the project specifically on San and Coro, I've probably touched on some of these points before. I think excitedly, the project has a 1 to 2 million ounce exploration target on it. That's limited to a depth of 100 meters. This is essentially your first pass look at a project. So that was done back in 2018. We've drilled gold mineralization down to depths of over 200 meters. So the view from SRK at the time was, you could find up to 2 million ounces of gold just within 100 meters from surface. So certainly our 800,000 ounce resource we have at the moment, we feel there's huge scope to increase it. On the back of that, we moved on and we delivered a maiden resource and a scoping study back in January of last year. Showed a great high IRR project, over 100% IRR at $1,500 gold price, which is great. And obviously followed up with a massive drill program we've delivered over the course of this year, 43,000 meters drilled, and we had a very nice 200% increase in resources. But I think it's worth saying the focus of that drill program was actually as much on infill drilling the resources as it was on stepping out and adding the resources. I think we importantly were looking to add indicated ounces so we could convert them to reserves as part of our feasibility study. I mean, had those meters all been put into growth of resources and just keeping them at inferred, obviously one would have expected a much bigger increase in mineral resource estimate. And the financing term sheet as well, we touched on earlier, but I'll talk more about a little bit later. Here's an overview of this drill campaign we conducted over the course of this year. As I said, it's 43,000 meters in total. We had some absolutely fantastic hits. I mean, 49 meters at over 15 grams a ton, 19 meters at over 31 grams a ton. These were seriously good drill intercepts we had, and showed huge potential for the project. The image on your right, what you can see there is essentially in the red area. It's the old December 2019 pit outlines, and then the green lines around it are how we've expanded the pits. I think what's important to show is we haven't actually stepped out very far to add 200% to our resources. We've stayed very tight on our existing pits. We've actually only drilled 7.5 kilometers of 33 kilometers of mineralized strike length on our permit area. So for me, whilst we're running very hard at delivering a feasibility study, we've got the term sheet in place already to help finance the project post feasibility study. I think the exploration potential on the permit's massive, and that's something we can look to develop further over time. Here's an update on that resource statement. I think there's two key things I guess I wanted to point out from this without getting too detailed on it. One is the significant conversion to indicated resources. Just for layman's terms, your initial discoveries and your initial resources generally inferred categorization, and that's a good enough categorization to complete the scoping study. But if you want to complete a bankable feasibility study to publish reserves and finance a mine, you need to convert your inferred into indicated. So, we had a dual focus in this drill campaign. One was to add in total more resources, but it was also, frankly, to get as much indicated as we could. So having nearly 70% of our gold in the indicated category was great, because that will obviously help the growth of our maiden reserves next year. But I think also importantly, we were targeting to get as much oxide material as possible. And I think it's important just to talk about what the value of the oxide material here briefly. Oxide material is essentially a free digging material. It has for us very high recovery rates. It obviously has a lower mining cost because you don't need to drill and blast it, and you can just dig it up and truck it away. And in terms of your processing costs as well, they will be significantly lower than an average benchmark processing cost as well. So for us, our oxides really are an exciting part of the project. At the start of this drill campaign, we thought we had oxides to depths of up to 120 meters. but now we've seen we've got oxides in certain pits down to over 200 meters, which is a real plus for us and gets us really excited about some of the opportunities with this project going forward. Another aspect, Donald touched on grade briefly. I think I've got some comparisons and to look at other oxide projects later in the presentation. I think in London, there aren't potentially a directly comparable project of our style, but I think what you can see here is people talk about cutoff grades again without getting too technical. Essentially, that you use a cutoff grade which is defined by the economics of your pits, which is defined by the foregoing gold price at the time. So we use 0.4 grams a ton. It obviously pulled in a lot of tons into our pit shells. But as you can see, if you used a 1 gram a ton cutoff, you've still got over 500,000 ounces of gold at nearly 2 grams a ton. So I think that what that clearly tells me is there's a lot of higher grade gold there, and ultimately there will be pockets of really good grade, which will obviously always help a mine plan. The next 3 slides are reasonably technical, so I'm not going to dwell on them in too much detail, but I think the plan view, you can basically see the pit outline, and ultimately we've kept the drilling fairly close to the pits. On the right hand side, you can see essentially a cross section of the ore body. The dark solid line is the old December 2019 pit shell, and then the stepped line below it is the new pit shells. So what we've essentially done is taken what was an average pit depth of 65 meters from our maiden resources, and we've taken them down to an average depth of about 140 meters in open pits. So essentially we've added lots of gold at depth below what were extremely shallow pit shells. We've also stepped out and increased the strike length of our deposits. I think it's important to say that all of our deposits are open both at depth and also up and down strike as well. So we haven't drilled out any of our deposits. All of our deposits we essentially ended in mineralization. So that obviously gives us great potential for the future growth of the project and for adding ounces in the future. The next slide shows a similar pattern of events at different deposits. Here we are at Zone A and Zone C. Interestingly, at Zone C, these are our first maiden resources there. We historically had no resources at Zone C, so that was nice to have a new discovery come into maiden resources again. It remains open and offers plenty of potential for future growth in the future. And again at Zone B, we encountered some really deep oxides there, so that's exciting. What you can see on the image there is it looks quite stringy, so you can see these pods of resources with gaps in between them in that image where you can see the pit shell outline. That isn't due to that hasn't been sterilized. There hasn't been results which have meant the gold isn't continuous through those zones. It just hasn't been drilled yet. So obviously, again, one would hope in future that potentially that would extend and join and make one larger pit with further drilling. Touching on our timeline, reasonably aggressive, keen to keep moving as quickly as we can. Obviously, just delivered the resource update. Excuse me, due to deliver our ESIA in Q1, and then our feasibility study, our DFS, should be finished in Q2 of next year. It's obviously in our anticipation we'll then move into permitting and financing, and then construction hopefully before the end of the year. We appointed all of our key DFS contractors over the summer, and they've all done site visits and they're cracking on with their work. They're making really good progress. It's really pleasing to see. We've got aspects of various DFS drilling ongoing at site at the moment for hydro and geotechnical work as well. So site's still very busy, and there's still lots of work going on. But yeah, it's good to see that timeline. It's good to always remind yourself of the next step and what you're looking to deliver over the coming months. I think one thing which does set Cora apart maybe from some other juniors at the same stage as us is a very strong commitment from our leading shareholders. Lionhead Capital is linked with our largest shareholder, the Quirk family. They've committed a term sheet of $25 million on completion of the DFS to support the development of the project. They have said they're prepared to syndicate up to a third of that with other shareholders. So they're by no means, they're essentially looking to underwrite the $25 million, but they're happy for other shareholders to come in and share in it as well. So they're by no means trying to wrap their arms around the project. They're obviously trying to give us great support, and they're very committed to helping Cora develop the project and move us into production as quickly as we can. And I think that's been seen with strong support in fundraisers over the last 2 years. Now I'm going to step away and talk about some of the regional projects before we come back to some corporate slides at the end. These are our Yanfolila group permits, essentially sort of donutting around the Yanfolila gold mine. It's obviously been operating for a few years now. We've had some nice hits. Tekla-Dugu, for example, sits extremely close to the Yanfolila processing plant. It's only 7 or 8 kilometers away. We've done fairly limited work on it over the last year or so. It's obviously something we'd love to get back to and spend more time on. Ultimately, we felt the best bang for our buck's been advancing Cora at this stage, but we've certainly got some exciting hits in shallow oxide material. So plenty of optionality there. If we can make a discovery and drill out even a smaller deposit due to your proximity to an existing producing gold mine. Again, this Dangote project area, a nice one to pronounce for everyone. As I said, it's in the Kenieba window, arguably the most prolific gold belt in Africa over the last 20 years or so. Some earlier stage permits, but we've got some nice drill discoveries. We've had some nice soil anomalies on them, and again, be good to get back and do more work and drill them out further in time. The brief overview on our share structure. I think probably better to go on to some of the peer comparisons on the next slide. But as you can see, we've got both Brookstone and Key Ventures is linked with the Quirk family, so they've been a very strong large shareholder of us, as well as Lord Michael Farmer, who co-founded Red Kite, which is a mine finance and commodity trading business. So they've been extremely supportive shareholders, as well as directors and management. Yeah, I think on the peer comparison, I think what I just wanted to really explain to people the case study of Robex. I think in the London market, people are used to seeing projects which are sometimes underground, or sometimes they're quite deep open pit, generally all fresh rock mines. And I think people then ultimately are looking for different things in those. I think what you can see in Robex, it's a Canadian listed company. It's an oxide mining operation in Mali. It has 0.7 grams per ton. So as our indicated materials are at 1.35 grams per ton. So significantly higher grade. I mean, they're producing 50,000 ounces at a sub $1,000 all-in sustaining cost, and I think last year they paid around a $35 million Canadian dividend off that. And I think that's the important point. I mean, we're trying to build a money mine, as I've heard someone at Whistle say before. Ultimately, we're producing gold, but ultimately we're a business and we're looking to make as much money as we can. And I think you can get fixated by a specific number in this sector, and I think it can have a lot of technicality to it. But ultimately for us, free digging oxide material from surface, so hopefully some shallow oxide pits should deliver us hopefully good free cash flow generation, and obviously that's what we're looking to show in the course of our feasibility study, which is ongoing at the moment. Bit on Mali and Senegal. I think ultimately very prolific gold producing regions. I think importantly both of them have had commercial gold mining operations for well over 25 years now, so you've had a number of majors and mid-tier companies operating there. Both have got very established mining codes. They've both got a very educated workforce, and relatively decent infrastructure for West Africa. Our project, for example, is about 4.5 to 5 hours drive from Bamako. You do 80% of that, 90% of that on a nice tarmac highway, and then the last 25, 30 Ks is done on a dirt road. So, very good infrastructure in many ways. Politically, obviously, you've had changes of government over the last year, and there have been security instances in Mali in particular, which people have probably noticed. So I don't think there's any point hiding away from that. I think what I would say is Mali is a massive country. Most of the security instances are generally well over 1,000 kilometers north of where the gold mines are. And I don't think in 30 years of commercial gold mining, any gold mines lost a day's production for any security incident or political change that I've been aware of. So whilst it might have a bit of an interesting look when you Google it, I think it's worth bearing in mind that there have been some of the most profitable gold mines producing in Mali over the last 30 years, and they've done so uninterrupted, even in the midst of what might appear to us, with some security instances and other things happening in the background. Last slide, just an overview. I think hopefully I've summed up Cora pretty succinctly. Ultimately, we're very focused on delivering Cora into production as quickly as we can. We've delivered a great resource update this year, over 200% increase in resources on the back of a scoping study from the year before. Our focus very much is on delivering a feasibility study over the course of the next 6 months, and then obviously from there moving into the financing and permitting as quickly as possible so we can move into construction. So that's it, Donald, and overview. Thanks everyone for listening, and looking forward to answering any questions there are.
Great. Okay, Bert, thank you. I've just got to say, you've made fantastic progress with San and Cora. Well done.
Thanks. It's not my work. It's the work of the team, really. So yeah,
It's always a team.
I'll pass on their thanks on your behalf.
Oh, indeed, it is always teamwork. Definitive feasibility study. You say H1, first half of the year. When exactly in H1 do you think that might be?
I think it'll definitely be in Q2, if we're being honest. I think like the environmental social impact assessment's due at the end of Q1. So it'll be sometime in Q2. Hopefully not right up against the end of it. But you know, there's a huge number of work streams ongoing. And I think we're all aware of the complexities that the COVID can throw at you around, you know, logistics and timing. So it only takes one small bit of test work to get stuck in an airport or stuck not in the lab you want it to be, and to be delayed 3 or 4 weeks, and suddenly everyone will tell me that I've not delivered to the exact month I said to you today, Donald. So I think I'll stick to Q2 if that's all right.
No problem. Q2 is good by me. If you can deliver on Q2, I'm sure everybody will be delighted. Environmental reporting, EISA, and permitting. I mean, how are those coming along?
Yeah, great. I mean, we started the ESIA back in May, June time of last year. So we started it well in advance on the basis that we knew we were going to be pushing ahead. So all the monitoring is going on, and you know, all the various consultations are happening. So I'm really pleased with how that's going. In terms of the permitting as such, to move into the 2 significant permits, you need your environmental permit and your actual mining permit. So essentially converting your exploration permits to a mining permit. You can't do those significant factors until you've completed the studies themselves. So that's something we'll be warming up obviously in advance. So I'm looking to go out to Mali in January, early January, I hope. So obviously you keep in good contact with the ministry, so they're aware of your timings and how you're progressing. So obviously once you've delivered the studies, you can hopefully expedite the permits as quickly as possible. And
was it last week you raised 4.25 million?
Yeah, it was. I mean, it closes tomorrow. So yes, we announced it last week, and the shares going to issue tomorrow. Yeah.
Great. So Rob Pickard asks, what proportion of that latest fundraise, the 4.25 million, what proportion do you anticipate will be used to fund Q1 exploration work? And let me ask, where will that Q1 exploration work actually be? And what areas are you prioritizing? Asks Rob.
Yeah, it's a very good question. Thanks. I think to sort of answer it backwards, if that's all right, I think one of the key points of this fundraise was to enable us to complete the feasibility study and also have working capital through the period of permitting and financing. Obviously, with the aim being our next financing will be the construction financing. So the aim is to give us working capital to deliver through the feasibility study and into through the period of permitting and financing. That said, you know, we believe there's obviously excess capital there to obviously look to do exploration work. I'm just working through with the geological team at the moment around planning that drill program to kick off hopefully in Q1. I think everyone's going to want to see probably resource growth, but obviously for our team, we're also keen to continue to see growth in indicated ounces, which will deliver your reserve mine plan, so you can expand your mine plan as well. So we're currently just going through that at the moment and having lots of internal discussion around exactly where the drill plan will be and how many meters we'll do. But in terms of budget, to specifically answer the question, probably around 15 to 20% of it hopefully will be going into exploration.
Okay, well, that's a good response. How much we're talking resources and exploration. I suppose what I always think, well, people instinctively are going to go for the easiest and most easily available resources first. They're going to go for the low-hanging fruit. So why are you so convinced that there's more good stuff to come, as it were?
I guess on one hand, you've got the exploration target, which obviously identified 33 kilometers of mineralized strike length. We've only drilled 7.5 kilometers of it. So clearly, you'd be extremely unlucky if all of the mineralized sort of surface strike length was unmineralized at depth below it, when we've obviously in the first 7.5 kilometers found plenty of gold. I think also you'd be extremely unlucky if all of your pits essentially ended in mineralization in your last sets of holes. If suddenly your next step out hole on every pit was barren, it's obviously extremely unlikely. The style of mineralization in West Africa, these things go on and on. So I think we're extremely confident because we know there's lots of gold there. We've obviously got sort of step out holes which haven't been brought into resources because there isn't enough density of holes yet. And obviously I think the other factor I'd say is all of these resources we've got are fully pit constrained. So ultimately, there is obviously more gold there, which ultimately does not fall within the pits, which have been constrained. So obviously we're already aware where there's more gold, and obviously you can look to infill and put more density of drilling around places to add ounces, certainly. But as I said, it's obviously a balance. Our focus very much is getting onto production and focusing on cash flow, delivering cash flow. So for us, there's a balance between adding reserves and adding total inferred ounces.
Yep. Okay. That gives me two different ways I can go. Let's talk term sheet. Let's talk financing. So when after the DFS can you actually draw on the term sheet, and when do you think that might be, Bert? And how does it work in practice? Do you want to just sort of break it down and tell us how you anticipate it's going to work?
Yeah, I think there's a few factors at play here. Again, I guess by putting sort of timelines and exact things on it, you always risk yourself tripping over yourself. But ultimately, there's there will be a debt package. There's obviously the equity term sheet, and which has already been signed, which we're looking to obviously convert and draw on. My expectation is that there's probably going to be a period of at least 3 to 4 months, potentially 5 months, where you're going to be looking to complete the permitting, and at the same time looking to negotiate and get a debt package as well as part of the project financing, and then obviously go through the various hurdles to sign off the term sheet. Ultimately, the term sheet, we need to get into detailed documentation on it. Obviously, I'm already engaging with Lionhead continuously. I had an update call with them yesterday, actually, to take them through the progress on the project. And between now and completion of the DFS, there'll be monthly update calls on them. So when the DFS is completed, they're not just seeing it cold. They're abreast of obviously the developments as the rest of the market will be with RNSs updating on progress as we go. In terms of the term sheet itself, as we said, up to 30% of it, the Lionhead are prepared to syndicate with other shareholders. I think we need to put in place we haven't put in place a specific mechanism of how that would work. But I think also, hopefully people can clearly see in the recent fundraise we did, which was at a premium to the spot price, ultimately that was led by our larger shareholders, happy to continue to hold the 10p price. They do have, and we do have, the interests of the retail and some of the smaller shareholders are in mind and at heart. So I'll certainly be looking to make sure there is a mechanism whereby smaller shareholders are able to come into the fundraise on the same terms as the term sheet, but that specific mechanism hasn't yet been set up.
Okay, which takes me neatly to a question from worried retail investors who say that they're worried that if they load up with shares now, they're not going to be invited to join the capital raise when it happens post DFS, and that they may get diluted in the process. So you've touched upon that, but it's quite complex.
I think I'm hoping. I mean, I'm obviously hoping the post DFS construction fundraise will be done at a higher price than we are now. Obviously, I think with a significant increase in gold resources, I'm hoping the DFS will show a much larger project than our scoping study currently does. So hopefully, the growth in the scale of the project, which the resources have delivered, will follow through in a feasibility study and show a more positive feasibility study than our scoping study in terms of NPV and size of the project. So I'm certainly hoping that the financing will be done at a higher price initially. But ultimately, I mean, look, I think I can only say, look, we'll do our best to make sure that the retail shareholders are able to come into the project financing as best they can, as best as we can. So does that answer the question, Don? I feel like I've lost my train there slightly in the middle.
Well, there's 30% which is going to be farmed out. Will it be part of that 30%?
Yeah, that's my anticipation. Yes, I mean that's give or take $8 million, which could be farmed out. So hopefully that will cover. I mean, given our largest sort of 3-4 shareholders are potentially own about 60% plus of the business, I guess the portion which doesn't own the other 40%, I would have thought even if everyone followed their money, they would be we'd be happy, there'd be space.
Okay. J. Deacon says, Bert, excellent progress at Cora. And then it's not so nice from now on, Bert. Hummingbird have repeatedly faced mining issues in Mali. What are you going to do to ensure that you can mine to plan? Brackets, I'm referencing Hummingbird's operations given your background. And for everybody else, you came from Hummingbird, right? Yeah,
I spent 10 years of my career at Hummingbird. I lived in Liberia on the Digby project, which is obviously being operated by a Canadian company called Pasofino now. I was, I guess, part of the corporate team when we acquired Yanfalila when I was at Hummingbird. And obviously, lots of that project's gone very well. And I don't necessarily want to dwell on that too long, but ultimately, the execution of the financing, the construction, ramp up and moving into production all went extremely well, and was very positive. But ultimately they've had obviously some negative issues which have impacted production over the last couple of years. And I haven't been there for a couple of years, so I can't talk in too much detail. I think in life, generally, you learn more from your mistakes than you do from when it's going well.
It's worth stopping you there, saying, Bert, how can you avoid making those mistakes? I think is Jay Deacon's question.
Well, I think obviously you need to hire the right management team to operate it and the right contractors to operate your mine, and make sure they don't happen. I think obviously you can learn from mistakes and operational issues which all mines across the region might have, whether it's the impact of a wet season on your open pit, or the pit slopes you're using, or lots of things you obviously look to improve on, look to learn from. So yeah, I think I talked about Russell Bradford having lots of experience. I think all I can do is look to bring in experienced people to help me operate the business in the mine. Okay,
and always a useful question. What might an exit look like, Barrett? I mean, fantastic. We've got to the stage in your project. We're actually talking, about an end game. What might your potential end game be?
Well, clearly, I mean, we want to build a mine at Cora, and we want to deliver that mine, and we think that's the best route to add shareholder value, and we're keen to accelerate it as quickly as possible. I think a lot of companies might have stayed in the exploration phase for longer before moving into a feasibility study. Our view is that that would continue to add dilution to our shareholders. So actually trying to move towards a position where we can construct a mine and deliver an operating gold mine will hopefully protect shareholder value as much as we can. In terms of an end game, I'm not even thinking about an end game at all. For me, the next 3 years is about delivering DFS, delivering permitting and financing, getting into construction and delivering a mine. I think that's hopefully what shareholders want me to be doing. And I think I haven't got any thought about an end game at all. I mean, yeah, we're looking to build a mine and deliver as good of free cash flow as we can, and trying to return money to shareholders as quickly as we can.
Bert Monroe, CEO at Cora Gold, thank you so much for joining us tonight. That was terrific. Thank you.
Pleasure. Thanks, Donald. Good to see you.
Our final company tonight is Longboat Energy. The Pharaoh management team sold for $900 million, and now they're hoping to do it all over again. As Longboat, they've raised £85 million and bought non-operational share stakes in 7 near-term wells, soon to be drilled in the tax-effective Norwegian sector of the North Sea. 2 of those wells are due to spud in December, 2 more thereafter, so lots to play for. And the Egyptian vulture find is currently being commercially assessed. Helge Hammer, CEO, joins us from Norway. Greetings, Helge.
Thank you, Donald, and good evening, everyone. So half a year ago, we announced 3 simultaneous deals with Equinor and Spirit and Idemitsu. We had built a bespoke drilling program of 7 wells. We went on through the approval and qualification processes and completed the deals in a timely manner on the 31st of August, ahead of drilling. We spudded the first well shortly thereafter, and we have already drilled 3 out of 7 wells. We made 3 discoveries. The Egyptian vulture well is by far the biggest and the closest to pre-drill expectations. I'm coming back to that in a second. The Rødhette well in the Barents Sea was also a discovery below the expectations in terms of volumes, but we believe still has a good potential of being commercialized. The Mugnetin well was also a discovery, but unfortunately in that case, what we had interpreted as a amplitude anomaly being an indicator of oil turned out to be a thick coal layer, which was one of the pre-drill risks. So that's a sub-commercial find. The wells have all been drilled very efficiently by the operators in a safe and safe manner and on budget. So that's all good news. We are now kind of planning for the next well. We are right in the middle of a very exciting period. There's a lot to play for still. The targets, the remaining prospective resources of the remaining 4 wells, 75 million barrels with a total upside of 267. So that's still a huge number, down from the 320 4, which was the number for the 7 wells. The wells are largely targeting gas resources, which we're very pleased with. Fits our thoughts on value and good ESG performance. These are all infrastructure-led exploration, all near-field opportunities, all within tie-back distance. That means they have attractive economics. They have good potential for commercialization through swaps or divestments from our side. And they also have a very positive environmental impact. In parallel with this active program, we're continuing to chase M&A opportunities, and I'm coming back to that. So let's take a closer look at Egyptian Vulture. This is a well that was targeting a very large seismic anomaly sitting in the Norwegian Sea just next to the Maria discovery. It was an old Pharaoh discovery. And here we had interpreted this vast anomaly as a potential layer of hydrocarbons in Cretaceous. And this came in on prognosis, extremely happy with that. A nice 36-meter hydrocarbon interval with a good quality sand on the top, which could be a good target for putting development wells in. The next step now is to assess all the data that was collected and then plan the appraisal strategy for this discovery. The key issues is, say, the lateral extent of this anomaly away from the well. And another key uncertainty is the Pvt analysis. This is interpreted as a very light volatile oil with a very high content of gas. It means it's close to what's called supercritical conditions, means it could behave well in a depletion drive. And as we have already highlighted in our press releases, we believe recovery factors can be significantly higher than what has been announced so far by the operator. Work will go on for a few months to make sure we have interpreted the seismic and updated the seismic interpretation, the reservoir models, the fluids, the recovery factor, before we go on to decide on the appraisal well and appraisal well location. This is in an area where a lot of discoveries are being made, a lot of development projects are underway, so plenty of opportunity here to commercialize. The two nearby big hubs is the Oxide and Christine fields. Both have ample gas and oil processing capacity. The other discovery we made in the Barents Sea was the Rødhette discovery, around 9 to 12 million barrels, which is not insignificant. We believe this could be developed in conjunction with other discoveries and volumes in the area. There's a lot of work ongoing to plan gas export from Goliath and Alke. Also, Tornerose, just to the north of Rødhette, is an undeveloped gas and oil rim discovery. There is also a lot of activity here to look at production of blue ammonia or blue hydrogen with gas. And this is an area where you have ample electricity and gas, and hence it's a good and very small population. So it's a good opportunity to use that energy for new type of blue transitional energy projects. If we go on to look at the next wells, we have 4 more wells coming. Extremely excited about this program ahead. The next well is due to spud this month. That's the Ginny Hermine, which we are operated by Equinor. Then we have 2 more wells operated by Equinor coming in the end of Q1, starting with Kveikje drilled by the deep sea Stavanger rig, and followed back to back by Cambozola. And then in the summer, early summer, we expect to spud Copernicus, which is the tendering for the rig is ongoing. That will be operated by Pignig, the Polish operator. If we look a bit closer at these wells, Ginny is in an area which we know intimately well from many years working in this area with Petroleum. We drilled the discoveries just to the south here, the Bug and Heim, which you see on the map there. And we also had the Pil and Bua, which became the Fenja project, and Njord. All of that were important Faroe assets. And so we are kind of right on home turf here. And the well is being drilled right in between two discoveries, the Galtvort to the west, and then you have Hasselmus to the east, which is a development project now because that has been sanctioned and is underway as a satellite to Drogen. In this prospect, we have stacked reservoir potential, Upper Jurassic Rogn and Middle Jurassic Garn, in which case, if it comes in at both levels, could be quite a significant volume. We then, let's say, take a look at the Cambozola, which is, we have 25% of a very, very significant prospect. This is what we could call a play opener in a mature area. It's a play opener because on long offset seismic, you suddenly can see these fans and channels, and they stand up as very bright. And with a lot of good gas indications, there are gas chimneys and shallow gas also in this area. So huge potential volumes immediately next to infrastructure. Kvitebjørn field is a big gas discovery and gas development project, which could be a host for Cambozola. And you have other giant fields here like Snorre and Gullfaks and the Troll field just to the south. And then look, zooming out a bit, you see how this is an extremely prolific area. A lot of discoveries have been made lately. That's because of the big advances in new seismic. So there are discoveries like Swisher, Equinus South, Blasto, Røversø, and so forth. So Equinor here is hoovering up discoveries to take into development. And Kveikje sitting right in that setting with a lot of discovery. The top and well is being drilled as we speak, and as soon as that's finished, the rig will come and drill Ginny. The Kveikje has a very high chance of success, 55%. That's because this has a strong anomaly, which is difficult to explain with anything else than presence of hydrocarbons. Potential is for this to grow is also very significant. So what we've seen with these type of injectites, there's all these sub-seismic volumes. It's what you've seen, for example, in the Catcher field in the UK, which is a similar type of setting. And then the last one, the Copernicus, is further north. It's still a tieback to infrastructure. The Polarled gas export pipeline and the Osterhansten field are the natural tie-in point for Copernicus. It has a DHI. DHI is a direct hydrocarbon indicator, also from high-quality seismic. And very, very significant volumes. And the gas from here can flow in pipelines all the way to the UK market through Polarled and then onwards across the North Sea. So that's the drilling program. We continue to be actively chasing M&A opportunities. We think we are in a very excited market right now with a lot happening. Norway is seeing a huge amount of development projects being brought forward to sanction. and that combined with relatively few players looking to grow and invest. There are some still growing, looking at much larger deals than us, and some looking at smaller deals. But this sweet spot of $100 to $200 million would be, say, an area where there are relatively few companies, but quite a lot of deals. So we are relatively optimistic on finding some attractive opportunities. The strategy for Longboat is unchanged. We set off to replicate what Petroleum did and build an E&P, a full cycle E&P company. We've started with exploration, but the intention is definitely to grow into production and build 2P reserves. We have a proven record. We have a very skilled team, a lot of competency in M&A, and we are all shareholders, so we're worried about share price being low. Means we have a lot of focus on any deals we do being value accretive to shareholders. The company is in a strong position financially. Very pleased that the wells that have been drilled so far have come in on budget. Means we are in well cashed up for the remainder of the program with equity capital and with the exploration finance facility. It's worth noting that the Norwegian government have proposed change in the Norwegian petroleum tax system. That's a very interesting change, because we have for years now benefited from the exploration tax refund, which has been hugely successful for Norway. It led to a lot of big discoveries and a lot of growth in production. The proposal by the government is to extend that exploration tax refund into a general repayment of the tax part of all your losses. So instead of just having an exploration refund, we get a refund against all our loss position, which means that the threshold, for example, for developing or participating in development for a small company is very significantly reduced, which again then have impact on the M&A market. So it opens up new opportunities for us. So that's in short, in summary then, we are well underway with a very exciting program. We drilled 3 wells, one significant success in the Egyptian Vulture. The appraisal well is being planned. We'll come back to that as soon as we're ready to make that decision. 4 more exciting wells with huge volume potential to come. Next well spudding already expected this month, and then further in end of Q1. And it's all focused on near field exploration. Delivering gas to the UK and to the continent is seen as, I think the recognition that the gas is important transitional fuel is awakening up thing that is happening in Europe. And in parallel, we are looking at value accretive M&A opportunities. Thanks for that.
So can I ask you, which of the 4 upcoming wells are you most excited about, and why are you most excited?
Well, the most exciting one is Cambozola, because you know, it's huge. It has all the kind of it ticks all the right boxes. We have 25% of it. It's a potentially huge company maker. Okay.
And the other 3?
The other 3 are all, I mean, they're all exciting. I think the 2 big ones are Copernicus and Cambozola. Ginny and Kveikja are more like bread and butter, but can be really good value creation for the company.
Okay. Let's look a little bit backwards. You seem much more positive about Egyptian Vulture than the market response, which was at best a little bit lukewarm. Have investors missed something here?
Yeah, well, I think it's something we've seen before. You know, it's a typical problem with an exploration well that sometimes you need to drill an appraisal well before the market really recognizes the potential value. I think that's what we see here, is that you know, I wish it was such that, let's say, one well could resolve all issues, and in some cases it can. You know, if it's a small, very well-defined structure and you drill a successful well. So if Mugnetin had come in as a success, you would have seen the market react immediately, because, you know, all the questions were answered. But this Egyptian vulture, you know, 80 square kilometers it's a huge area, you know. So and 440 million potential, you know, STOIP. This could become a big field, but that takes more than one well to prove that up.
The appraisal well element of it, I mean, how much of that is fully funded already?
We do have, you know, if the wells that are in the program for next year come in on budget, then we're well funded for an appraisal well as well, actually.
And how much might that appraisal well actually cost? Even very roughly?
Yeah, it depends a bit on the program, you know, because that could end up being a well that is tested, for example, and then it could become a more expensive well, but somewhere in range 40 million.
Okay. So these things aren't cheap, no?
No. I mean, you're in the Norwegian Sea. You have like 6th generation, you know, semi-subs. So, but see, that's the cost side of things. But then if you make a discovery here, you can pipe it right into the market, you know. So.
Yep, and there's the upside.
Yeah.
So it's all risk-reward stuff, isn't it, Helge?
Absolutely. And I think that if you look in the Norwegian sector, it has delivered huge values for shareholders of companies. You know, you look at companies like Lundin or Aker BP or Faroe up till it was sold. So it's after Faroe was sold, exploration records have been very good. You know, you're looking at up to 50% success rates. So
and let's talk to the tricky side of oil. Oil is deeply unfashionable at the moment. Shell have pulled out of Cambo post COP26, or perhaps they were going to pull out of Cambo, nothing to do with COP26. They're just pulling out of oil altogether. Oil extraction is seen as a dirty business. So why do Longboat still believe in it?
Well, I think it's you know, oil and gas is needed for years to come. You know, it's I think there's a wake up happening. You see the electricity prices and gas prices in the UK, and we have the same here in Norway. You know, the shortfall. You know, we had huge investments in renewables. That's all very good, but you see that, you know, you get into intermittence problems. You know, you get all sort of issues. So you're going to need gas and oil, and I think gas particularly is very interesting, because gas is actually very efficient from a emission point of view. So I think that's another one that is happening, and I think it's unfortunate that with the uncertainty in the UK, political uncertainty that has kind of occurred, and Shell hasn't made it any easier, obviously, but we continue to be optimistic. I mean, we've kind of put a little pause button on the UK, but expect to be, and so I think our strategy is to be an active E&P player both in the UK and in Norway, still valid. But
would those tax breaks make Norway more attractive than the UK, though? Yes,
and I think also it's you know, political support is still strong, and I don't know if you noticed, Norwegian Prime Minister was probably the only one in Glasgow who dared to say that oil and gas has a role to play. I think
Nicola Sturgeon used to tell us it was Scotland's oil, but strangely enough, it's no longer Scotland's oil. Hey, what can I say? Politicians are fickle, Helge.
Yes.
Okay. Swaps. Are you still seeing deal appetite in Norway? Are you confident you'll be able to swap discoveries for production in the current market? There's been talk of you taking some of your assets and swapping them.
Definitely. I think that's absolutely core to our strategy. We would love to swap Egyptian vulture for some production. That would be a brilliant deal. You know, you have Pignig. Pignig, for example, is in the asset with us. Pignig is the Polish gas company, very hungry for gas, continue to make acquisitions and to make Poland gas sufficient without too much Russian gas. So the politics there as well, but plays into our hands.
Helge, why would somebody give up current production for future hope?
Well, that's a volume trade-off, and it's a future kind of volume trade-off. But that's you know,
it is potentially doable, though.
Definitely. I mean, it's you know, companies that lose out, you know, and it could be infrastructure owners. You know, you have infrastructure owners in the Oxide and in Christine suddenly find that they have less and less of the equity production that goes through the infrastructure. And then they see other companies like us suddenly adding volumes in the area. They would look to rationalize. Maybe they give up some oil production somewhere else to be in a nice gas field development in Norwegian Sea.
Okay, which takes us neatly to a question from the London South East chat board, which is often where I go to find my questions, to be honest. Have Longboat been economical with the strategy? Said somebody on the board, Helge. Firstly, it was buying production, then it was exploration and swapping into production. Now it's looking like you're buying production again. Discuss. Are they being a little bit tough on you, do you think?
No. I think it's it's an absolutely valid question, and it's a good question. And answer is our strategy hasn't changed. We are out to replicate Faroe. We are out to build an E&P company, but we also have to look at deals that are value accretive, and we have to do. And the thing with the deals and the market is it swings. In end of 19, we launched Longboat. We were about to do production deals. We had them lined up. Then COVID hit and the oil price dropped and the market just dried away. Then a few months later, half a year later, we recognized nothing was for sale in terms of production, but everyone were looking to divest their exploration assets. So exploration became a unique opportunity, you know. And it's interesting that Equinor, if you look at we did a big exploration deal with Equinor. If you look at the last Equinor announcement in the quarterly last week, they say they are now on the hunt for farm-ins. So we hit the exact right timing for getting some farm-ins done. So we are still in the market. We're focused on value accretive deals. Could be, and we're building an E&P company. That's what I said. We have a lot of dialogues going with companies at the moment. We don't have any active processes, but
so what you're saying is it's important to be opportunistic, even though it makes it look as though externally you're flip-flopping, but you're actually have a firm focus on becoming a full cycle E&P company, and it just doesn't really matter whether you start at this end of the cycle or that end.
Absolutely, and I can assure you, we have continued to review all the production opportunities been in the market. There hasn't been a single regret. The deals that have been done, we've kind of said no, thank you, and they're not been done at terms that we would have accepted.
Okay. Can I ask a question from Niall Savage? It's slightly complex, so let me run it past you and see how we get on. How many employee incentive plans are in place, and what are the share price triggers, he asks. Have the targets become less ambitious since the IPO? And he says, I know that all the information is in the various RNSs, but the RNSs are quite wordy and technical, so a simple clarification would be very helpful. He just basically...
Yeah, I can't be kind of too... it's difficult to quantify this on the spot, but we have 16 employees, 4 in London, 12 in Stavanger. Everyone are incentivized on the share price the way we like it to be. It's I would say it's typical UK AIM company incentivization. Nothing kind of extraordinary in terms of the
I think he's basically what he's trying to get at is, have you made life too easy for yourselves in terms of getting bonuses on, because the share price is pretty low at the moment. So
no, but I mean nothing has been realized. I mean the share price has to go way up before anything can be realized, and it's kind of too early anyway. So
okay, so on two levels, it's too early. Okay. Yeah. So how would you give me a final thought? What do you feel about progress so far? 3 down, 4 to go. That's your first roll of the dice. Are you happy? Unhappy? Tell me your frame of mind.
I'm obviously unhappy with the share price. That's the only thing I'm unhappy with. Apart from the share price, I think I'm very happy with the progress we're making. I think we are on to build a very substantial and very exciting company. I mean, we are in some absolutely key wells, and deals that we're looking at are looking extremely interesting. So I would say, except for the share price, we don't recognize this, but I think I can understand that more information, more success, all of that will come through. But apart from that, I'm very excited about where we're heading.
Thank you so much indeed for your time, Helge. That was absolutely brilliant. I really enjoyed it. There's so much detail in there. I really want to go back and listen to that all over again. Thank you. Well, that's it. That's it for 2021. A huge thanks to you for being such a great audience and for staying with us to the end. We're always grateful for your time, and we look forward to doing it all over again in 2022. Good night, and have a very enjoyable Christmas holiday, everybody. I think we've truly all deserved it this year. Enjoy it when it comes. Thank you, and good night.